And all this uncertainty is making the global economy nervous. Stock markets are down, inflation is up, currencies are volatile. All of these are bad omens. Usually they mean something bad is around the corner. The question is how bad? Best case scenario, a slowdown. Worst case scenario, a recession. Let's start with the biggest headline. Across the world, stock markets are in free fall. Let me show you the numbers. The FTSE All-World Barometer dropped 3%. Now, this index represents equities around the world, so 3% is a major drop. In fact, it is the largest since June 2020. In the United States, Standard & Poor's fell 3.2%. Japan's Nikkei dropped around 0.5%. Europe's Stock 600 fell 2.9%. And in India, the Sensex was down 0.2%. In other words, it was the worst day for global stocks since 2020. What triggered this meltdown? Broadly speaking, two things. Number one, the overall economic uncertainty, the war in Ukraine, China's lockdown, the Omicron flare-ups, all of these are unknown variables. During such times, investors move away from risky assets like stocks or cryptocurrencies. Bitcoin, for example, it dropped 10% on Monday. Instead, investors look for safer investments, which brings us to factor number two, the US Federal Reserve's announcement this week. The Fed hiked interest rates by 0.5%. Now, this is a much safer option than stocks or Bitcoin. It is guaranteed interest payments. So naturally, foreign investors flocked to America, and the result was this. The US dollar strengthened. Take a look at this table. The Chinese yuan fell 500 basis points. It is trading at 6.72 against the dollar. The Indian Rupee plunged to 77.44. That's a record low for the Indian currency. In simple economics, if the dollar is strong, your local currency will fall. For Asia, this is bad news. In the last 4 months, Asian markets lost $2 trillion. 2 trillion, that's what they've lost. And this includes China, Japan, India, Southeast Asia, basically the engine room of the global economy. What explains this exodus of investors? The biggest reason is China. Most Asian nations have moved beyond lockdowns. They're reopening their economies, but not China. Xi Jinping is doubling down on zero COVID. No free movement, no deliveries, no factory work. Xi Jinping is draining the life out of China's economy. And the numbers support this. China's exports have hit a 2-year low. They were up 15% in March. But last month, in April, they were at 3.7%. How does this affect the rest of Asia? In two ways, through trade and through tourism. China is the biggest trading bloc in Asia. They buy up raw materials, they sell consumer goods. But zero COVID is slowing down that trade. And same with tourism. Chinese tourists used to throng Southeast Asia. After zero COVID, that inflow has disappeared. The bottom line is this. China is central to the Asian economy. If China slows down, Asia slows down. So the immediate solution is clear. Xi Jinping needs to start listening to the science. He needs to reopen the Chinese economy, but that alone is not going to be enough. The world economy is simultaneously dealing with three changes: the pandemic, the rising cost of debt, and finally the war in Ukraine. For developing economies, this could be a deadly blow. Just look at what's happening in Sri Lanka. All three factors were at play. The pandemic dried up tourism in Sri Lanka. Russia's war made fuel and food expensive. And finally, the debt became too much to handle for them. Chances are this is just the start. What's happening in Sri Lanka could happen to other countries as well. The United Nations, in fact, has identified 69 of them, 69 such countries, 25 in Africa, 25 in Asia Pacific, and 19 in Latin America. These 69 countries could go the Sri Lanka way. Last month, we told you about Nepal. They banned the import of luxury and non-essential goods. Why? Because they're running out of dollars. You could see other countries following suit. The question is, how does this affect the global economic recovery? In a lot of ways. For starters, inflation is at a multi-decade high. And how do you tackle inflation? By increasing interest rates. That's what central banks have been doing. They've started doing it already. But what if their interventions are not enough? What if interest rates rise even more? That could derail economic recovery, possibly push us into inflation. Now, usually central banks can handle these situations. They have the tools. But this time, there are more variables than usual. Like the war in Ukraine, if the fighting drags on, food and fuel will become more expensive. It doesn't matter how many times you hike interests. And if that happens, what will countries do? They will have no option but to borrow more. And we all know how that ends. Falling revenue and rising loans, aka the Sri Lanka syndrome. So the next couple of months will be crucial for the global economy. If the war ends, there will be more certainty. If not, things may spiral out of control. WION is now available in your country. Download the app now and get all the news on the move.